Hello, my name is Przemysław Kwiecień. You are watching XTB Weekly Trading webinar. Today we are going to discuss reflation. We did discuss the prospects of increased inflation, increased bond yields in past webinars. So today we are going to figure out which markets may actually benefit during such circumstances. But before we do that, let's start typically with our top news on Monday morning overview. And yeah, basically the bottom line remains the same. Markets remain very upbeat despite the bad news that we got last week, especially Biden tax proposals. Markets were able to actually score fresh highs for S&P 500. So it's quite incredible how resilient markets are right now to any kind of bad news, and yeah, just push higher. One of the factors that might help this direction is a strong start to earnings season on Wall Street. Well, obviously it's the estimates for earnings are always a bit on the low side, so it's, you know, we have these beats all the time, but this season these beats are especially large. Then we had a surprising decision from Bank of Canada last week. The bank decided to trim quantitative easing, whereas the ECB stay on put. So we take a look in a minute on the loonie and the other parts with the Canadian dollar. And yeah, as you can see on the chart, the data points at very rapid economic expansion, since people have a lot of money because of the transfers and the lockdowns, and you see an explosion of demand. So unlike last year where we had a bottom, this year it's exactly the opposite. Obviously, the question is for how long can this be sustained with this policy that might lead to some overheating, and then the question mark is what's going to happen in the longer run. But for now, the growth is looking very, very strong, and the week ahead is going to look very intensive. Federal Reserve meeting on Wednesday, US GDP on Thursday, and lots of earnings reports which we are going to discuss in a second. So let's start with this Bank of Canada decision that where the bank remained accommodative, obviously, and they maintained the interest level on a record low of 0.25%. However, they said that they would decrease the weekly QE program from 4 to 3 billion of Canadian dollars, and that's the first such move among major central banks. So the reasoning the bank says is that the economy is moving in the right direction, and rates are still low, and they will remain so probably towards the autumn or late 2022. So the bank says, look, we are still accommodative, but we are just slightly adjusting this impulse. This is in theory very positive for the currency, because if you look at the Fed, at the ECB, what they are doing nothing. They say, look, we are still worried, inflation is temporary. So, you know, you look at the economy, you look at the data, and you look at what they say, and you think these are two separate words. So Bank of Canada is actually a rare exception where they see what's happening, and they want to take a very small preemptive action, just not to be too much on this overheated side. So very smart move, you would say, and a move that could potentially be positive for the currency. Here on the chart you can see that the Canadian dollar actually had a good period, because oil prices were on the rise, because US dollar was weak, because risk appetite was there. So all these factors are typically positive for the Canadian currency, and that was the case over the past year. However, like I said, this decision is potentially another factor that could help Canadian dollar in the medium term. When we look at the pairs, US dollar to Canadian dollar, it remains in a strong downward trend, and this decision only supported this, because, you know, we had some kind of pullback here, and that decision, you know, helped to drive the pair back into the slide. So as we can see, over a medium term, this is a strong downward trend on the US dollar to Canadian dollar currency pair. Whereas on the euro to Canadian dollar, this situation is a bit more mixed from a technical perspective, where before the decision we actually the pair actually increased past this important zone, which is low from May 2020, but the decision helped to drive it back below it. So if we figure out that Canada is doing better than Europe, that oil prices are on the rise, that central bank is supporting currency through less, I would say, reckless monetary policy than the ECB, that's all positive for the currency, whereas the pair is still much higher than it was before the pandemic hit the markets in the early 2020. So technically, maybe it doesn't look as good as the US dollar to Canadian dollar pair, but fundamentally it looks like it could have some downside potential for the pair, so it means positive potential for the Canadian dollar. Let's move on to the Biden taxes. Well, the news was something fresh after plans to rise the income, the corporate taxes. Now we have a proposal especially to rise the capital gains tax, nearly double it for the rich. Well, if you look at the deficit this year, it's already on pace to be higher than last year, and even with the Fed purchasing a lot of treasuries, it's still not enough. So obviously, if they want to, so even without extra proposals, the deficit will be post-war record this year in the US. And obviously, with the Biden infrastructure plan and other plans from Democrats, obviously, it's only adds to the expenditure side. So it's obvious that you need some revenues at one point. So this is technically negative for the markets, because it means, look, there's nothing for free, and those that benefited the most from this bull market are about to pay at one point. However, the impact was very, very short-lived. If we look at the indices, we can see that the situation remains broadly unchanged. We are still in this megaphone pattern. By the way, a similar pattern ended the bull market when the pandemic hit. Obviously, the pandemic was very exogenous situation and something that could not be predicted in any way, but and therefore we cannot be sure that this pattern has similar consequences. However, the market just behaves similarly like back then, where there was no negative reaction to pretty much anything, and right now it's the same thing. Bond yields on the rise, that's okay. Now higher taxes, just 2 red bars here, and the market keeps pushing higher. So in the short run, the momentum is very, very positive, be it on S&P 500 or the Nasdaq. Perhaps it could be affected even more by both bond yields and capital gain taxes, but again, like you see, it just hovered around the highs, but no significant impact here. So but this is certainly something that needs to be watched. Okay, let's move to the story of the week and the reflation environment and how it could potentially impact certain markets. So let's start from what reflation really is. So if we look at the definition, it's a period where the economy expands at a rapid pace after some kind of a crisis, supported by fiscal and monetary policy. So it's definitely the period that we have now, right? So we had a crisis, we have fast expansion, we have lots of interventionism or support, whatever you want to call it. Whereas from the market perspective, reflation is a period where you see a rise in both inflation and bond yields. And if you look at history, I just give you one chart not to overwhelm you with tons of it. You will see that there were not really that many periods of reflation in the past. Actually, because inflation was on downward trend in the US for decades, we need to move back to 80s and 90s to really have some periods of reflation, because the only period over the last 20 years was few months of 2016. So really there aren't too many cases which we can take for analysis, and eventually I picked 87, 94, 1990, 2000, it's a mistake here, and 2016. Of course, there are a lot of signs, not only of rapid economic expansion, but also inflationary pressures. The latest charts that was very popular last week is a chart of used cars in the US, which, as you can see, the prices of used cars are behaving nearly like a Nasdaq. So it's incredible how strong the demand is. So let's take a look which markets really actually did well during these reflation periods in the past. Well, industrial commodities did very well. As you can see, oil, WTI and copper increased by around 3.5% a month in this period. So if you take into the account that these periods last few months or a year, like in the third case, these are very substantial gains here. So these markets definitely did very, very well. And if you can see, if you see at the charts, if you take a look at the charts of copper, let's say, you will see that this is indeed taking place today again. Just the week started with another bullish gap, and the market is really, really exploding. 2 points here. First of all, this is this gain already looks like it's incredible. It's more than 100% from the bottom here, and it's really parabolic in hyperbolic in its look. However, if you compare it to what happened in 2009, you will see that actually this market moved even more back then. So I wouldn't be surprised to, given the fact that these markets always did well during the reflation periods, because if you look here, especially copper, these gains were very consistent among these cases. So I wouldn't be surprised to see these prices go to the fresh highs. However, on the other hand, it's not a long-term investment. As you can see here, after this period of explosive gains between 2009 or late 2008 and early 2011, then there was a long bear market, because obviously for commodities you have a response from the output size and from the miners, and eventually this demand wanes and there is more supply, and then the market is congested and the situation reverses. So it may very well happen this time around. You have a lot of demand right now when there is a lot of transfers, where people spend money, where everyone is going crazy with this end of lockdowns, so on and so forth. But I think after a few quarters at the latest, this demand is about to start waning, because, well, there is this growth is mostly a result of a pent-up demand and interventionism rather than really strong long-term fundamentals. So at one point growth will start waning, whereas probably higher output will arrive, and a similar situation cannot be ruled out. So obviously we don't know exactly, but it's a very strong bull market that not necessarily is a very long-term phenomenon, rather short-term thing that definitely could go higher, but doesn't necessarily need to stay there for years to come. Looking at the other markets, we also see that precious metals do not fare very well. So especially gold, something that we discussed already in past webinars, that during periods of increased bond yields, gold prices do not behave well, and that's confirmed here. And then finally, interesting observation, I think, because normally people say that traditional value stocks do well during periods of reflation, which doesn't seem to be confirmed, because as you can see, the Nasdaq did manage to provide the highest monthly return, and even if you do not count it because of the 99 case, where it was a peak of dot-com bubble. So obviously Nasdaq did very well back then, but even if you compare Russell growth to Russell value, you will see that Russell growth outpaced value in 3 out of 4 situations. So actually this growth value thing doesn't seem to be confirmed, at least by this data. So also looking at stock names, when we look which stocks managed to outperform during these periods of reflation, you will see a lot of tech stocks like Nvidia, National Semiconductor here, or Micron Technologies, Applied Biosystems, Qualcomm. So a lot of tech stocks during this period. So again, argument that it's not necessarily a bad period for tech. And finally, I think also observation worth noting. You will see here that during these periods of reflation, stocks generally manage to stay on the positive side, and actually in some cases, actually they recorded quite strong performances. However, in 2 situations out of 4, this reflation period preceded market crashes. So this is also something that's worth bearing in mind. So we had 2 situations where this reflation, took place after a period of, sideways market, and actually it was long-term positive. And we had 2 situations where this reflation period occurred at the end of very strong bull markets, and actually heralded something not so positive in months and quarters ahead. So at the end of the day, remember, these are just 4 periods, and that's markets never close to physics, so you cannot say for sure this is going to happen like this, and especially now with these markets so skewed by the Fed and monetary policy, it's definitely worth being cautious and worth remembering that just the fact that copper or oil did so well in the past doesn't mean that for sure it's going to be repeated. It's a hint, but it doesn't need to doesn't need to continue. All right, let's take a look at the week ahead, and what we have is a really strong calendar. Because we had lots of data, we had the FOMC meeting, and we have lots of important earnings from big tech and big companies. So let's start from the Fed. This meeting is this kind of smaller meeting where you do not have materials, you only have the decision, statement, and Powell conference. So a statement is going to be probably relatively neutral, and the decision obviously will not change anything. So the focus will be on the conference, where perhaps Powell will be asked about the Bank of Canada decision about the taper outlook given these inflation pressures. But I expect him to be on the denial. So he'll say everything is temporary. So obviously this is going to be positive for the market short term, because he will avoid a situation where he can spoil anything. However, obviously in the longer run, this is very dangerous, as this means that we are on some kind of a collision course, and ultimately we may have a situation that if inflation really accelerates in the months ahead and accelerates strongly, markets may panic because they will be aware, okay, the Fed is wrong, so what's going to happen? So it would be better off for the Fed to be more cautious now and try to prepare markets for something that might not be avoided, rather than risk this crash later on. But it is what it is, and we just need to be aware of the broader picture. Other than the Fed, which is on Wednesday in the evening, we have, like I said, lots of releases, especially between today and Tesla in the evening, then Microsoft, Google tomorrow, on Wednesday Apple and Facebook among others, and Thursday Amazon. So a lot of quarterly reports and a lot of macroeconomic reports, with especially US GDP on Thursday being the one that is going to be watched, with the official consensus of 5.7% annualized, which seems to be a bit on the low side, because how strong the data was, especially in March, I wouldn't be surprised to see this growth even higher. So we're going to have a very intensive week, and yeah, with these markets that are ignorant to any bad news, strong earnings season may actually push things even to even greater extremes. All right, ladies and gentlemen, that's about it from my side. I hope you enjoyed the webinar. Please stay with us in the XTB trading platform, in the news section, in both web and mobile version. We try to keep you updated every day from morning to the evening. I wish you a great week, and we see each other next time around. Thank you. Bye.